If you are of the younger variety of human and you find yourself in the insurance marketplace between the age of 25 and 55, here's a guide on purchasing term life insurance. Now, though I love all 50 states of the great union that we live in here, this is about the time that I kick off anybody who's not in the states of Maryland, Virginia, Pennsylvania, or the District of Columbia. That's because this region has a national treasure that no other region in the country has. I've built my entire business around it and I'd like to keep it at home. As per usual, I'll explain more towards the end of the video. So the way some people feel about term and the reactions I've gotten throughout the course of my career as a financial advisor, we might have lost some people just from the beginning having mentioned it, as it seems to be either loved or hated in the insurance world. And that's a world I've been in just about 9 years. My name is Austin Lewis. I am the owner of Bay Life Brokerage, a veteran-owned financial services company. We specialize in life insurance, disability, long-term care, and annuities. It's that hate part that inspired me to make this guide on why you might need term and how you should be purchasing it if you do. So if you know about term, you probably know about whole life. Now, these are two types of very popular insurances. I'm going to break down a brief difference between the two before we break into the further details. In short, term is temporary coverage. It's a contract that guarantees death benefit as long as premium is paid for a given time period, versus the more popular whole life, which is a permanent form of life insurance. And because of its permanency, it accrues a form of equity called cash value. Now, as an independent brokerage, I have access to pretty much every type of policy there is: final expense, whole life, index universal life. And there's a very specific reason why I use term and offer term to many of my clients. And that's because it's a great coverage option for large amounts of coverage needed that usually diminishes over time. So effectively, term can be used to match a specific amount of debt that will be paid off over time, using the death benefit to match the outstanding principal amount on that debt, and the term period to match the amount of time it will take to pay that debt off. Perfect example of this is, of course, your mortgage, right? A home purchase. So imagine here that you purchased a $500,000 home, which in the DMV region is pretty common. And you get your average note on a home for 30 years. So in this scenario, we would use a 30-year term policy, a policy that is active for 30 years with a beginning $500,000 death benefit. This is the amount of money that would be payable to your family if you were to pass away, and use that proceed to actually pay off the house and not have to worry about making those payments on your home in the midst of the turmoil of losing a loved one. Now, of course, this is not the type of insurance that we want to actually be used, right? We want everybody to live a long and prosperous life with their family. So as you pay that debt down over time, right, the amount of life insurance that you have, that amount of coverage that you originally took out, is no longer needed, nor is the same amount of time, right? So in year 25, you don't still need 30 years. So having matched up that term, right, in year 25 of a 30-year term, of a 30-year note on a mortgage, you will only have 25 years left of coverage and 25 years left of payments. You can also reduce your term death benefit down, matching the current balances. And the reason why you would want to do this is because you will actually receive lower bill on your premium, because of course you're now being covered for less and less. This prevents you from actually having to pay on that portion of your insurance coverage that you no longer need. Now, another classic financial planning instrument for term insurance is to replace income. And again, here we're looking at time and debt. How much time do we need this coverage, and how much money needs to go to the family in case the loss were to occur? So I'll give you an example here of a family that has a youngest child at the age of 2 years old. Now, the family obviously relies on the annual income of, let's say, the husband, but it could also very well be the wife, of $75,000 a year to maintain their standard of living. With the expectation that this child and the entire family is relying on this income, and that the income would also be needed to send the child to further schooling after high school, which most parents would like to do. The child can be expected to be financially dependent for the next 20 years on that annual income. So in this scenario, we would provide a 20-year term to cover that 20 years, and we would take the $75,000 annual income, also multiply that by 20 to get the aggregate sum of expected annual income over that period of that child's life, which in this scenario is $1.5 million. So the perfect fit to make sure that your family will continue to be able to prosper and your children will continue to maintain their standard of living and to still be able to fund the future goals of that child, we put in place for you a $1.5 million term for 20 years. So I'm a numbers guy, so let me show you what I'm talking about. In that same scenario of that $500,000 home purchase, let's say that was a 40-year-old male in good health that made that purchase, and he wanted to be covered for his family. In whole life, that $500,000 I'm quoting right now today with the top insurers, best price of at minimum $550 in monthly premium. That same coverage for that 30-year duration of the mortgage to actually cover what he wants to cover and nothing more. Best price I'm quoting for a minimum of $42 a month. So you see, term allows these high dollar death benefit needs to be paid for at a fraction of the cost of other types of products. But of course, built into that policy is an automatic stop loss saying we're no longer going to charge you for this coverage anymore because you no longer need this coverage. So of course, my favorite part of the content is how do we go about purchasing one of these policies if we feel we need one? And of course, the answer will always be an independent broker. Basically, all that means is that you need to be looking at insurance with somebody who has the freedom, who is not contractually obligated to go with any one company, who has the freedom to go around searching for the best companies and the best products. And by doing this, you can have your broker leverage you the best prices and the newest and most unique plans. Now, pretty much every investment and insurance company offers term life, but the prices and requirements vary widely. And this is what a broker can do for you here. We quoted a 35-year-old non-smoker male looking for about $250,000, 30-year term insurance. And we saw quotes ranging from anywhere $24 to $45 a month and all kinds of quotes in between. So from 24 to 45, that's over a $250 a year difference in price for the exact same product. In addition to this, some require full medical exams. So one application for the exact same type of coverage with one company might trigger a full paramedical exam where a nurse has to come see you, do blood, urine, all that good stuff. With another company, they might be willing to issue it without any of that, just asking questions. Again, same coverages, different process. Only an experienced broker knows how to navigate this. I personally know of companies that will issue you coverage under the age of 55 up to $2 million in death benefit without a medical exam. And there's the bells and whistles, right? These little features that most people don't know about. And it's not from lack of trying, it's just not what you do every day. So I understand, but this is what I do every day. And so when it comes to things like coverage for major medical events like cancer, kidney disease, heart attack, stroke, child and spouse coverage, or disability income coverage, I know of the plans and I know of the companies offering those plans, and I know how much more, or sometimes in many cases, how much very little more, sometimes no more in premium it's going to cost you. So by not using a broker to navigate all these features, you're not only possibly leaving money on the table, but you're also possibly leaving added coverages in that policy on the table that really could bring some real value to you. In a term policy, odds are you're not going to pass away while the coverage is in force, and that's a great thing. That's not a waste of money. It's covering the risk. But the risk, the numbers also actually say that you're going to have some sort of medical event. And with extra coverages like living benefit riders on policies, those medical events can now also be covered with those life-ending events. And at many times from anywhere from $5 to $10 extra a month in premium. Now, the reason why I kicked everybody out earlier in the video who wasn't in our tri-state area is because not only do I own this financial services brokerage, but I'm also a huge advocate and activist for the Chesapeake Bay. I live on it, I fish in it, I swim in it. So the health of it is entwined between me and my family, but also in many unknown ways with the rest of the region as well. I try to use my position as a board member on a local charity and my own blood and sweat to go around picking up trash as ways to help improve the environment of the bay. And I'd like to only do business with those that feel that same passion for our home and the waterways that we love. If you're in the Maryland, DC, Virginia, or PA area and you find yourself, possibly just from watching this video, hopefully, that you might need term insurance coverage, we would love to be the brokerage to shop for you.